Testing. What's up, investors? Pancakes. Sorry, testing mic. Testing. Anyway, I'm gonna do the account review today. By the way, this is the video log. Takes 30,000 to a million. I do account reviews and I try to do some education here and there about various financial topics or whatever's in my mind. This is mainly just kind of like a log, journal, if you will, for myself personally, but also I share some things that I learned along the way to $1 million in through investing, and so I try to share as many of those as I can with y'all. See if I can help anybody else on their journey. So today, what I'm going to do after I take you through the account and show you all the positions in great detail, you can skip that part if you want, all the charts and all that stuff, until you see either my face like this blown up or the stockanalysis.com website, which I'll be using to kind of determine whether or not a stock is safe. All right, there's a lot of risk involved in buying stocks out there, so I'm going to just mention briefly some of the factors that a few of the risk factors that increase the risk of the stock, and so you know what you're betting on. Like, one company is much safer than another for many reasons. Not all stocks are born the same or are the same. They could be born similar ways, but all right. So first of all, I'm going to go to the account. I'm going to do the account review, and then I'll have a talk about the safety of the stocks. So I'm sitting at $790 right now and 20 cents, which is an all-time high close, I believe. Not an all-time high, but an all-time high close. So good enough. And my positions are on the right here. You're going to see a lot of these positions are going to expire today. I try to do some weekly option sells. So anyways, I'm just going to scroll down. You can view all the positions in detail if you pause the video player at any moment. So a lot of these expiring today. These are some longer dated ones, and these are leaps here, long-term call options basically. These are my equity positions. I did a short NASDAQ hedge for like $1,000. Might get rid of it pretty soon. I'm down like $20 already on it. So in retrospect, today I shouldn't have gotten it, but I think that this market's been running pretty hot, and so therefore I'm trying to give a little bit of way and see if I can save my account from the inevitable down leg. I don't know when it's going to come, but it's going to be one pretty soon, and I don't want to just sit around idly watching it. I know it's kind of like working on market timing, and I mentioned before I'm not good at market timing whatsoever, but the chances are that next week we're going to experience some red at some point, and I want to have at least some kind of profit on the downside. But anyway, I have Apple, which was about flat today. Realty income was up a little bit. Main Street Capital up a little bit. Goldman Sachs down. For the most part, everything was flat. In fact, I finished the day $35 up. You see this amount here. Only $35 up. However, after hours, it was $400 in the positive. I don't know which company, probably Apple. Yeah, I don't know. Combination of Apple and something else. So you've seen the accounts, you've seen the daily performance. I'll do a relative performance in a little bit, but first we go into the account tab. Here's the account tab. I'm sitting only on 32% leverage. 16 times 2 is 32, so that's not too bad at all. This is the account by position. By position size. So Apple is like 3 times bigger than the next position, which is Main Street Capital. Paramount Global is the next one, and then Realty Income. All of them are pretty large positions. Smith & Wesson only 17, and Goldman Sachs only 6. I will probably get rid of Goldman Sachs if it goes up to 400. I don't know about their medium-term performance, but we'll see. If it goes down to like below 300, I might sell some puts if I have the available resource. All right, so relative performance time. 1 week performance, well, today is basically flat, up like 0.02. 1 week performance 3.6. 1 month 20%. 3 months is 15.85, and then 1 year is 22. Whenever I show the all-time chart, I always have to mention that I started investing in August 28, 2018, somewhere around here. So that's why the chart looks so flat before that. I didn't really have much money in the account at all, maybe a few $100 or something like that. So overall, the count is up 186 minus 3%. Let's say 183% over the course of the last 4 years. That's pretty good. It's fairly good return here. Now, I'm going to compare it to the SPY, which is an exchange traded fund that's correlated with the S&P 500 index. So the top 500 most best performing, well, not best performing, but they have to be profitable, largest, most profitable companies in the United States, at least that are based in the United States. So today actually was, I think I lost on Nasdaq, but I beat the S&P 500. So 1 week only 1.65%. 1 month is 10.83, which is not bad, but half of my account, so that's great. 3 months, I'm actually up like, I don't know how many percent, but the S&P 500 is down, so I think I'm up like 10. So not winning by much. 1 year is only 5.79 down, so that means I'm winning by quite a bit. And 5 years, 67. But forget about the 5 year. Let's see, 1 year, so down 5.79 year over year, and I'm up 22, so beating the market by almost by more than 28%. So huge. Very happy about that. All right, now I've talked about the market, relative performance, and some of the reasoning behind some of the moves. Let me know if you want me to explain something in detail, by the way. I'm really looking forward to things like Paramount going to $30 or so. I'd really like to exit that position, as well as Smith & Wesson. Oops, that's not Smith & Wesson. This is Smith & Wesson. Going up to 15 or above in a month or so that'd be good for me to exit those positions. I could use the money, cash out of that. So those are some of the moves, and now for the next phase of the video, I'm gonna talk about how to determine whether a company is safe for you to operate with. Like, not all companies are equal, as I mentioned, and there are a lot of factors that go into it. One of the most important checklists is, in my opinion, this is just my opinion only. I'm not a financial advisor, by the way, and everything I say here is just for entertainment purposes. Don't sell or buy any stock mentioned in this video or otherwise based on the information you received in this video. Okay, now, one of the first things I look for is jurisdiction. So what that means is, like, where's the company based of? The best probably jurisdiction in the world right now is the United States. It has the firmest, most well-established corporate law structure. It has a tradition of capitalism and investment. It has protection for companies, corporate entities, unlike any in the entire world. So this is the best jurisdiction in the United States for investors. And no wonder that the markets are very, very extremely well capitalized, times over the rest of the world, per capita, I guess. Not in total, but it's pretty close. So one day, I actually did a video one time comparing the size of the US market companies versus the rest of the world, and it's pretty eye-opening. But anyways, moving on. So jurisdiction is number one. Number two would probably be profitability. That's it. Not even size. I think number two is profitability and a history of profitability. So let's go into the stock. I use stockanalysis.com. It's probably my new favorite free site that I use. And let's just look at a company like, I don't know, AMD. I've never looked at this before, but AMD seems to be a very popular company today. I think they did pretty well on earnings, I believe. Let's see, yeah, they did pretty well in the last few days. In the last 1 month, they're up like 44%. I mean, it's incredible. This is what their max chart looks like. So fairly volatile, it was up like 150, blah, blah, blah. So not even looking at the fundamentals, like, you can just tell by the numbers how much risk you're taking. Okay, so I'm going to skip all these numbers and just go to like operating income, but some people prefer net income or whatever. But I like to look at operating income myself. But find out whether they are actually earning money or losing money. So this company is making money. It's accelerating its rate at making money, 3.65 billion. So that's not bad operating income. But relative to the size of the company, which is $168 billion, that much income per year is not that good. I also like to go to quarterly charts, and you can see in the quarterly charts that income is actually dropping. So it kind of peaked out a couple quarters ago, and it's actually dropping down. So now they're only having, an annual rate of 2 billion. So 5 times 4 is $2 billion dollars per earnings. So the earnings just basically dropped in half, or dropping in half, and this trend is a bit worrisome. For most of the history of the company, they've had about net zero earnings. So they're reinvesting, they're focusing on their business, which is fine. But the problem with that is, like, they're probably not returning much of that money to investors, right? So they probably don't hold a dividend, for example. They don't have a history of returning capital yet. Let's go to dividends. Yeah, so they don't have a dividend. And let's take a look at their shares outstanding, which is the third thing I look at. Like, are they taking care of the investor, and are they able to? So if they have a dividend, is it sustainable? I'll show you what it looks like later. So it looks like shares outstanding, they're actually diluting the shares. What that means is that they're increasing the amount of shares outstanding, which means that your ownership gets cut to a proportion, a smaller rate of ownership than you did yesterday by owning one stock today and one stock yesterday. All right, so let's say 2015, what you own there, it's basically half now as percentage of the company. So even though the company is bigger, your percentage ownership of the company is less. All right, that's how that works. Now, so overall, because of these factors, this company is actually pretty risky. It's going to be volatile. Not necessarily risky like it's going to go out of business tomorrow, but it's reinvesting a ton of cash, and it's trying to, outcompete, and it might get itself in trouble. Let me see what the next thing I look at is how much debt they have. And it looks like by just looking at the enterprise value and the market capitalization, I can tell they're actually sitting on a little bit of cash. So we're going to go to net cash here, and you can see they're sitting on $3 billion of cash. So that's pretty stable. And I really like that. Like, a lot of times when you get a growth company, they will sell a lot of stock, and they'll burn through a lot of cash. They'll borrow more cash. They'll go in big debts to try to grow and outcompete the company, and they'll dilute their shares as well. And so what happens is, like, if something goes wrong with the company, then they go under. It can drop like a stone. You could lose like 90% of the share value or more. You could go down to zero. You could get bankrupt. You can go really far down and get bought out by another company for pennies on the dollar. So a lot can happen, and that is, is not optimal. So obviously, so what you want to do is you want to check all these variables and make sure that they're not very indebted and just diluting like crazy. Okay, so it looks like AMD, it's risky, but it's not that risky. Okay, like if you put your money into AMD, you can be rest assured that they're not gonna go bankrupt anytime soon. Okay, so you're making a bet on the company. It could drift lower with time if it gets outcompeted by a different chip maker or whatever, or a graphics card maker, whatever their main product is. But it's gonna be slow, and they're not gonna go. You might get halved, okay, because of the recent quarter earnings trends. Might get half in value from here or something like that, but I don't think it's going to go out of business anytime soon. It's not going to go down 90% in the next 2 or 3 years. That's a fair bet. Obviously, there's always a chance of anything can happen, but I wouldn't say it's that risky. But let's take a look at something that's, known for its stability. Like, let's say Johnson & Johnson. I've never looked at this company. I'll do it first time right now. I may have done like a quick look, but I'm just looking at it now. So it looks like it's really large company. It's $451 billion, which is extremely large. Oh, one other factor I forgot to mention is, size. So in order for a company to get to a certain size, it means that they've already been through a lot of trials and tribulations, and the market is assigning a high valuation because of their ability to be in business for a long time, and they show that they can grow through numerous scenarios in the on the world stage, through difficult economic challenges and whatnot, and they have a good record, right? And so they're able to grow. They've proven everything they have to proven. So the market assigns them a high valuation for that's one of the reasons. And so that is actually a sign of safety as well. So how big a company is contributes to its safety factor. So Johnson & Johnson here, let's skip all the other stuff here like revenue or whatever. It doesn't matter right now. Let's just go to the income. So it looks like they're very stable, modestly growing. 23. It's it's better than NMD. Let's take a look at the quarterly and see how they're going. So they look extremely steady, right? They have some down quarters, but for whatever reason, maybe they have some unexpected expenses, whatever. But it's an extremely stable company. In fact, now they're making more money in 2013, 2012. They're probably increasing their earnings at the rate of inflation. So that just screams stability. But obviously, it's not gonna get as big of a PE as price to earnings ratio as AMD. It's actually even, in my opinion, a little bit high here for what I've seen so far. When we go to the statistics screen, the way you can find out how much cash they have is subtract the enterprise value from the market cap, and I'll tell you how much cash they have. Sometimes that number is negative by a lot. So right now it looks like to about flat. So they're just sitting flat, not really net cash or not net debt. Oh, yeah, exactly. 29 million, which is basically zero, right? These guys operate in billions. So it's kind of like you have 29 cents on your credit card. That's exactly the analogy. That's how well they balance their cash. So they don't like to sit on cash, so that's fine. So everything looks pretty good here in this company. Like, you're just very much paying for stability, and that's the premium here. So the jurisdiction is the US, right? Let's see if they pay a dividend. So they pay a dividend. It yields really high, well, relatively high to the S&P 500, about on par, maybe a little bit more. And what you want to look at here is the payout ratio. So the payout ratio means that 61%, 61.7, that means that the dividend represents 61.7% of their earnings. So it's fairly safe. Sometimes when they push 80% or higher on a stable company like that becomes a little bit unsafe. They're probably not going to increase the dividend anytime soon. They might cut the dividend if the business starts going sour a little bit or under like bad economic conditions. But at 60%, it's sitting pretty safe, especially since you saw the earnings were pretty stable. So you can even scroll down through their dividend history. You'll see that they've been increasing dividends pretty steadily. Lately, they've been increasing it. Over here, it says at 5.38% dividend growth. And that is, on par with inflation, probably a little bit under at the moment. But I'm sure that it's on par in the long run. So you can be safe assured that this dividend will keep up with inflation. It's going to be safe. The company has been around for ages, and it's extremely stable, and it's in good jurisdiction. So this stock is like really safe. Super safe. You probably have to do some industry specific research as well. All right. And also, just by itself, oh my gosh, I should have done this. All right, there we go. I didn't move the screen for y'all. I'm sorry. There you go. So you can see the dividends now, etc. And if you want to go to the overview, if you want to see the operating income, it's right here. Let's see if you can see it just fine. Yeah, all right. So this company's got everything going for it, right? I mean, it's even got like a little bit of growth, and it definitely keeps up with inflation here. Let's go to the quarterly. I like to look at the quarterly. The revenue's steadily growing with the pace of inflation, or even higher a little bit probably. And let's see the shares. I didn't look at the shares. Okay, look at this. So the shares are actually going down at a very modest rate, but still, with time, what that means is that you own a bigger percentage of the company with time. So they're buying back shares. They're buying back all the shares that they issued to other people. They're buying it back and retiring the shares. And the people who are left holding shares, those shares are valued more, right? They own a bigger percentage of a company that's actually growing at a modest rate. Let's take a look at the price action. I mean, so I predicted that this was a very stable company. Haven't looked at it before, really, not like this. And we're gonna go out like 5 years, and you can see that that bears out. I mean, it's up 30% in the last 5 years. If I go max, it's gonna be up more. Since 2007, right before the Great Recession, it only dropped from 70 to 50. That's it. All right, you guys see what I'm talking about? Like the Great Financial Crisis. Okay, boop, this little thing right here. The Great Financial Crisis, the biggest challenge of our generation this far in financial markets. It only dropped from 70 to 50. The entire market dropped more than 55%. So if you want safety, like Johnson & Johnson, okay? All right? So, Pinnacle Safety here. And you can see it. Look, 160% over the last, I don't know how many years, 15. Nothing to write home about, but you're not going to lose your capital. And this company has very little chance at going bankrupt in the next few years. So if you want your money to be safe, to be earning stuff, this is it. Let's take a look at another example. What's another safe company that people brag about? McDonald's. They have a lot of real estate. I don't know what the symbol is. MCD probably. Yeah. Okay, so McDonald's another safety. Let's go backwards in here to figure out. So since 2007, same chart. McDonald's actually increased quite a bit more than Johnson & Johnson, 490%. But it's probably not as safe. No, you're probably laughing me saying McDonald's not safe, and I actually think they're extremely safe because they own a ton of real estate. Did you guys know, fun fact, that McDonald's collects twice as much money from leasing the land on its franchisees than actually from sales? I think they collect, I heard this yesterday or today, they collect over 8 billion, a little bit over 8 billion on their land lease, and then they collect 4 billion or something, 4.5 billion or something on the franchise fee, or through sales, through the franchise program. My mind was blown. I knew they had a lot of real estate and they own all the land underneath, but not that much. So that's pretty crazy. McDonald's, really, really safe company, up 490% over the last 15 years or so. Let's see how they did this year. Oh, let's see how they did in 2008. Okay, so 2008. I can't even find it here. Look at this. 2008. This is the biggest crash, right? In modern times. From 64 to 53. Basically nothing. A bump in the road. They dropped a lot more during the 2020 crash. From 215 to 148. Not even, it's like 25%. It's not even that bad. And it quickly rebounded. You can see another very steady chart here returning. Let's see what the financials look like. Switch right over to quarterly. It looks extremely stable, very much the same. They had only one bad quarter here in 2020, obviously, March. So what about the shares diluted? Look at this, returning capital to shareholders by giving them greater ownership over time. Really looking out after the shareholders. Very good stock to own if you're a shareholder. Very safe. You put two of those together, Johnson & Johnson and McDonald's, and you got one safe bet, right? You can stack a few of these companies. How about the dividend? Okay, 2.08. Not bad. A little bit probably under the S&P 500, but it's fine. Payout ratio is 56%, even safer than Johnson & Johnson. Dividend growth is higher than Johnson & Johnson. It's 6.05. So probably keeping up with inflation in a better way. This is the history here. Looks like they increase about once a year. They make a dividend increase every 4 payouts or 5 or so. So that's pretty good. Extremely safe. So you get what I'm saying? How about an unsafe company? I know you guys are wondering, okay, fine. You know, I understand Johnson Johnson, McDonald's, but show me what an unsafe company looks like. AMD was medium risk. It wasn't that unsafe. But how about this one, right? Fisker. I like the name. I like the company. I like the Fisker Karma. You know, the car that they made. Company went bankrupt, and then the same guy, is designing, I think, the new Fisker Ocean. But let's take a look at this, right? Let's not even look at the price yet. Okay, we'll go to quarterly. We'll look at their finances. Revenue non-existent, $12,000 last quarter. That's zero, right? Basically zero. You made more money than this company did last quarter, probably, maybe, if you got a decent job. So operating income. All right, there you go. Growth company, a lot of risk. Okay, you see this negative $123 million in operating income last quarter. The previous quarter was even more, so at least the trend is reversing a little bit. But it's losing many millions of dollars, right? It's probably lost $1 billion so far. Trying to develop the products and get the sales out there and whatnot. So shares, diluting shares, right? These bars are going up. That means the shares are getting diluted. But by how much? By a lot. Look at this. In 2018, probably had like 10 million shares. Now it's 296 million, okay? Just from 2020, it was 100. Now it's 3 times higher. So if you owned one share in 2020 of Fisker, right? Now, let's say you owned 1% of Fisker. Now you own 1/3% in Fisker with the same amount of shares. You see what I'm saying? So mad dilution, extreme risk. So in order to keep the same ownership, you're just going to have to keep buying shares to keep at the same percentage ownership of the company. So very risky. Okay? You have to look at these things in order to determine how risky this is. Let's look at the statistics. Market cap or enterprise minus enterprise value. That means they're sitting on $500 million in cash. So that's not bad. So they still have some cash to burn. But you saw how much they're losing per quarter. So this is good for another 3 quarters maybe. $364 million, burning at a rate of 120 per quarter. They'll be out of money in 9 months. What are they going to do then? They're probably going to issue more shares and dilute your ownership even further. You see what I mean? This is a big risk. Big risk. Like if you buy Fisker and you just think you're going to be fine and you're just kind of waiting on the company to be profitable, to make their cars, and then you just get off the top, that's not the case, okay? They will dilute you, right? You might own 1% of the original shares that you had if you just sit on them. You have to keep buying if you're a believer in Fisker, all right? You basically have to keep financing them or you get diluted and the share price will go down. It's not that easy to get in this growth game. You could win a lottery ticket, like if they do really, really well and they sell all their vehicles and then develop more models and now they start taking over the EV market or whatever, what have you, because of their superior car, fine. All right, but even if they do make those cars and even if they do make a lot of sales, you still probably lose. Okay, the company will still be a money-losing company. It might forever be a money-losing company. Okay, but you don't understand that. Okay, well, some of you maybe, but if you're watching this far, you probably don't grasp how dangerous this is to invest in companies like this, especially if you haven't done any homework at all. You know what I mean? So please, go over there, look at some of their what the company what's inside the company, how much cash they're burning, how much cash they have, are they selling, what's the history when it comes to dilution, like how much are they diluting investors by, and realize that this is just risk. It doesn't mean it's wrong, okay? It doesn't mean that you're not going to make a ton of money. If you put money on Tesla 10 years ago, that was extremely risky, okay? but you made money, right? You hit the lottery if you held on to it. All right. Same thing with Fisker. We don't know. Most of them are not gonna make money. There's a billion EV makers right now. Most of them are not gonna make money. They're gonna die out. Okay. It's risky. So whenever you see a company like that, risk. If you're looking for safety, this is not it. All right. You're gonna lose your money, most likely, or hit a jackpot. Maybe you'll be break even, but anyway, the volatility in your making ability is extremely high at this point. All right, I hope I drove my point across. I've been yelling at the mic yelling at the mic for like a lot of time now, trying to explain this. But I'm trying to save you on money and hassle and mental pain in the future. So with a little bit of homework, you can determine to figure out, okay, is my money going to be there, 9 months from now, or is it all going to vanish? I think I'm going to leave it right here. I think this was an important one. If you are investing in a risky company and you know it, let me know which one in the comments below. Peace out.